Hi, everybody, and welcome back to video number 4. When we left off, we were looking at how we present depreciation um, on the balance sheet. And here you're going to see that that our equipment, that's going to show it what we paid, which was $50,000. And then accumulated depreciation ratchets up every period. In this case, we only have one period of accumulated depreciation. So our net book value is 49,600. I call it net book value. This calls it book value, and you get the idea. It's the difference between accumulated equipment and accumulated depreciation in this case. Okay, unearned revenues. Now here, that's an easy one. We've received some cash in advance before we've actually done the service. So here, our cash receipt before the revenue is recorded, and we often will have unearned rent, customer deposits, magazine subscriptions, sometimes tuition at Santa Ana or college or airline tickets, etc. So what we will do in this case, Pioneer has received $12,000 from our Knox for advertising services, and we expect those services to be completed by the end of the year. Pioneer credited the payment of unearned service revenues. So that's a liability. We've credited that $12,000. So that shows on the October 31st balance sheet of $12,000. Now, based on the evaluation of the service Pioneer performed for Knox during October, the company determines that it should recognize 4,000 of the 12,000. So the logic would be October would be 4,000, November would be 4,000, December would be 4,000, and we would recognize that revenue in those respective months. And so in October, what we're going to do is we're going to have a debit to unearned service revenue here that will reduce that liability by $4,000, and then a credit to service revenue, earned revenue on the income statement, showing that we've earned that revenue. All right, so here it's showing how that adjusting entry is not cash. It's going to affect one balance sheet account and one revenue account. So we are crediting earned revenue in this case and debiting the adjusting entry for accrued revenue. Now, in the case of accrued expenses, we will debit the adjusting entry and credit the liability for those adjusting entries. Okay. Now, revenues recorded for services performed, but cash has not yet been received at the statement date. Now, this happens as well. So the revenue recorded before the cash receipts. Here, we have rent, interest, and even services that are performed. So what does that look like? Here, we've performed these services worth $2,000. They weren't billed or invoiced to clients on that date. And because the services are not billed, they're not recorded. So the accrual of the unearned service revenue increases an asset, in this case, accounts receivable. So we're going to debit accounts receivable and credit the revenue account, service revenue. And that's how we would record that accrued revenue. And as we see here, that's just what we did. We debited accounts receivable and credited service revenue as an adjusting entry for those amounts that were unbilled or uninvoiced at the end of the term, end of the period. All right, so for accrued expenses, this is by far the most complex and common accrual that we make at the end of the month. And the big one here is down here is going to be wages or salaries that we will do. These will be salaries or wages that have been incurred, but not yet paid to our payroll service, usually. Okay, so let's take a look at how that works. We sometimes have accrued expenses in the form of rent, interest, and taxes as well. So here we signed a 3-month note payable in the amount of $50,000 on October 1. And that note requires interest at an annual rate of 12% to make the arithmetic easy. So we now know what our monthly interest is going to be. We take 12% of $50,000, that's going to be $6,000, and we take 1/12 of that, which will be our interest that we've accrued on a monthly basis. So now we need to record that. And what we do is we debit interest expense in the general ledger on a journal entry and credit interest payable. Remembering that we're not paying this in cash yet. So it's going to be a payable, not cash. So don't fall into that trap. Okay, so accrued salaries and wages, this is, again, the one we do every period. So you want to be sure you've got this one down. On October 31st, we have salaries and wages for a few days at the end of the period that we have not yet paid. The employees receive total salaries of $10,000 for a 5-day work week, and we're saying that's $2,000 a day. So there are 3 days in the adjustment period, October 29th, 30th, and 31st, and that is $6,000. So what we're going to do is we're going to accrue that, and we're going to debit, as it's shown here graphically a little bit to make this easy. Here's our adjustment period down here. And I guess these people are paid monthly. So Friday is the last payday here. So this has not yet been paid. It'll be paid here on Friday, but that'll be into the next month. All right. So what we're going to do is we're going to debit salaries and wages expense for $6,000 here and a credit to the payable salaries and wages payable here. And away we go. So now in November, we're going to do the same thing again, but we're going to pay the $40,000 in cash here. But part of that was due to October, $6,000. So we'll zero out the salaries and wages payable as $6,000. We'll have additional salaries and wages expense in November and a total cash payment of $40,000. Okay. Now, bad debts. Bad debts, we estimate the allowance for uncollectible or doubtful accounts at the end of each period, and that ensures that our receivables are stated at their net realizable value, the NRV, and assume that based on past experience, we can reasonably estimate a bad debt expense for the month at $1,600 to make the analysis easy. So we're going to assume right there and then, even though we've had no real bad debts expense, we're going to book this bad debt expense of $1,600 in that month, which is October. So as you can see here, that is a debit to bad debts expense and a credit to the allowance for doubtful accounts. Now that's going to hit the income statement right away as a bad debt expense, even though we haven't had any bad debt expense in this month. See how that works? And then as we have real bad debt expense, we'll debit that allowance for doubtful accounts and credit the specific customer's accounts receivable. All right, so here is all our accounts after the adjusting entry. And as properly shown in this description, it's an adjusted trial balance. And of course, the debits equal the credits. And now we're ready to go with our financial statements. And we have all the information we need down here for our income statement. So away we go. And here is that trial balance. Okay. And here are some adjusting entries. I'll let you work through these on your own, but we have 5 adjusting entries just like we did. And now we're going to show the adjusting entry debits and credits. Assume this again is review for you, so I won't take too much time on this. And now here's our trial balances with, in this case, we show the adjustments in a 6-column spreadsheet, which is very common, I might add. And away we go with the adjusting entries and the adjusted trial balance. And these columns here and here are our adjusted trial balance. Now we'll do the financial statements from the adjusted trial balance. And again, we're going to do them in a specific order: income statement, retained earnings, and balance sheet. And this describes that process very nicely here, I think. Here are in red are our income statement accounts. And we'll roll that into a income statement where we have our revenues less costs and expenses give us our net income. The net income then is going to roll down here, and we're going to back out additionally this dividends, which are shown here in cyan. I guess that's that color. And we subtract that here to get to retained earnings ending. And then we're going to take that little jewel and bring it over into the statement, into the balance sheet. So we bring all of these balance sheet items directly from the adjusted trial balance, shown here in red, over here. But the retained earnings comes from the ending balance of this prior slide here, which is shown here. And if everything's done correctly, the balance sheet now balances. Our total assets equals total liabilities plus stockholders' equity. Okay, now to do the closing entries. What we do is we zero out the income statement, temporary accounts, and dividends. All the income statement account balances and the dividends are closed. And here our balance sheet accounts are not closed. And here they all are. We'll zero out the income statement account here. And here we'll zero out our balance sheet accounts, or our expense accounts, and cost accounts. And we put that balance into income summary in a 2-step process. And then we zero out that income summary here and here by doing that here. And we have a 1-step process for doing retained earnings. We simply zero out dividends and debit retained earnings to reduce it. Okay, that looks like a good place for us to stop video number 4. And when we return, we'll look at posting those closing entries. Until then, bye.